When people think about the Great Depression, they imagine empty factories, dusty farms, and men in suits selling apples on street corners. But economic catastrophes don't just happen overnight. They build slowly, fed by greed and delusion, until one moment when reality crashes through the fantasy and everything falls apart. America didn't collapse into the Great Depression because of bad luck or natural disaster. It collapsed because millions of ordinary people were tricked into gambling with money they didn't have in a market built on lies. The lessons from that collapse still apply to every modern investor who thinks they can ride bubbles forever and get out before they burst. Let me start with a simple principle. Easy money always destroys rational thinking. By the mid-1920s, America was drunk on prosperity powered by cheap credit. The Federal Reserve had cut interest rates to help Britain return to the gold standard after World War I. This decision flooded the American economy with borrowed money, creating what economists call moral hazard. People take bigger risks when they believe someone else will pay the price. Between 1924 and 1929, the Dow Jones Industrial Average nearly tripled, rising from around 100 to almost 400 points. Think about this. That's like the market going from 30,000 to 90,000 today in just 5 years. Everyone had a story about their neighbor, their barber, their taxi driver making a fortune on Wall Street. Investment trusts were multiplying like rabbits, each promising to make ordinary people rich. Understanding the Federal Reserve becomes crucial here. Unlike today's central bank with its dual mandate, the 1920s Fed had one job: maintain the gold standard. By keeping interest rates low to help European allies, they accidentally created perfect conditions for speculation. When money is cheap to borrow, people use it to chase higher returns in increasingly risky investments. Most of that money wasn't real. It was borrowed. Gresham's law kicked in here. Bad money drives out good money. When easy credit becomes abundant, people abandon conservative investments for speculation. Savings accounts paying 3% look foolish when stocks are rising 30% per year. By 1929, investors could buy stocks with as little as 10% down, borrowing the other 90% from their brokers. They called this buying on margin, and it turned the stock market into the world's largest casino. A $1,000 investment could control $10,000 worth of stock. If the stock went up 10%, you made $1,000 on your $1,000 investment. But if it went down 10%, you lost your entire $1,000 and still owed the broker for the $9,000 loan. Let me give you a modern comparison. Imagine buying a house worth $500,000 with just $50,000 down. If house prices drop 10%, your house is worth $450,000, but you still owe $450,000 on the mortgage. Your entire down payment vanishes. Now imagine that happening to millions of people simultaneously. By October 1929, margin debt had reached $8.5 billion, equivalent to about $140 billion today. But the real number was much higher. Banks were lending money to brokers, who lent it to customers. Insurance companies were buying stocks with policyholders' premiums. Investment trusts were using leverage to buy other investment trusts, creating pyramids of debt stacked on debt. The human element makes this real. School teachers invested their life savings based on hot tips from students. Factory workers mortgaged their homes to buy shares in companies they'd never heard of. Retirees cashed out their conservative bonds to chase easy money. Housewives formed investment clubs, pooling household money to buy the latest Wall Street darling. The social pressure was enormous. Not being in the market made you a fool, someone who didn't understand the new era of permanent prosperity. Financial magazines proclaimed that old investing rules were obsolete. Even respected economists argued that stock prices had reached a permanently high plateau. That phrase would become infamous weeks before the crash. Some observers saw the warning signs. Paul Warburg warned in early 1929 that speculation had reached dangerous levels. Roger Babson predicted in September that a crash was imminent. But these voices were drowned out by the roar of easy profits. The crash began on Thursday, October 24th, 1929. Black Thursday. The opening bell rang at 10 a.m., but within minutes, something was wrong. Sell orders flooded in faster than buyers could be found. Prices started falling, slowly at first, then with gathering momentum. Let me explain what was happening mechanically. As prices fell, margin calls triggered automatically. When someone bought $10,000 worth of stock with $1,000 down, they received a margin call if the stock fell to $9,000. They had to immediately deposit more cash or their position would be sold. But everyone was getting margin calls simultaneously. Selling drove prices down, which triggered more margin calls, which forced more selling. By noon, the trading floor looked like a battlefield. Brokers were screaming orders, papers were scattered everywhere, and the ticker tape couldn't keep up. Outside on Wall Street, crowds gathered to watch the financial apocalypse. Police put up barriers to control the mob of ruined investors and curious onlookers. The afternoon brought a brief rally when major banks stepped in to buy blue-chip stocks at above-market prices. For a few hours, it seemed like the worst was over. Newspapers the next day suggested that the selling climax was finished, but it wasn't over. It was just the first act. The following Tuesday, October 29th, delivered the death blow. Black Tuesday. More than 16 million shares changed hands in a single day, compared to the normal 3 to 4 million. Imagine today's New York Stock Exchange suddenly processing 5 times its normal volume with 1929 technology. Prices collapsed in free fall. RCA stock fell from 505 to 26 over a few weeks. General Electric dropped from 396 to 168. These were America's industrial champions, equivalent to today's Apple and Microsoft collapsing simultaneously. Stock certificates that represented life savings became worthless paper. Millionaires were wiped out before lunch. But the real devastation hit ordinary investors who had put everything into the market. If you borrowed $900 to buy $1,000 worth of stock, and that stock fell to $500, your broker demanded immediate cash to cover the loss. You had to pay up or sell everything. But everyone was selling, so there were no buyers. People lost their stock investments, their homes, their savings accounts, everything they had pledged as collateral. The human stories are heartbreaking. A taxi driver lost his life savings of $8,000 and had to sell his cab. A widow watched her late husband's insurance money disappear. College students saw their tuition money vanish. Farmers who had mortgaged their land lost both their investments and their farms. Winston Churchill happened to be visiting Wall Street on Black Tuesday. He wrote, "Under my very window, a gentleman cast himself down 15 floors and was dashed to pieces." The suicide stories became legend, though newspapers reported only about 100 nationwide. The real tragedy was the quiet destruction of millions of ordinary lives. The stock market crash was just the beginning of a decade-long economic collapse. Bank failures followed like dominoes. Banks had been using depositors' savings to speculate on shares, directly or through loans to stockbrokers. When stocks collapsed, banks couldn't cover withdrawals. In the 1920s, most banks were small, local institutions. A typical community bank might have 80% of assets in local mortgages and business loans, with 20% in liquid investments like stocks. When the market crashed, that 20% became worthless, but the bank still owed 100% to depositors. Between 1930 and 1933, more than 9,000 banks failed. To grasp this number, today there are only about 4,000 banks in the entire United States. People's life savings vanished. There was no FDIC insurance, no government guarantee. When your bank failed, your money was gone forever. This created a deflationary spiral. As banks failed and money disappeared from the economy, prices began falling. Deflation sounds good until you realize it makes debts impossible to pay. If wheat prices fall from $1 to 50 cents per bushel, a farmer still owes the same mortgage payment, but needs to sell twice as much wheat to make it. The mathematics are brutal. Imagine owing $10,000 on your house when you earn $2,000 per year. If deflation cuts your income to $1,000 per year, that debt now equals 10 years of income instead of 5. The debt becomes impossible to pay, forcing default and driving deflation deeper. By 1933, unemployment reached 25%. 1 in 4 Americans couldn't find work. In cities like Detroit, unemployment exceeded 50%. Industrial production fell by half. Millions lost their homes and lived in makeshift camps called Hoovervilles. The Dust Bowl hit simultaneously, turning farmland into wasteland. Farmers who might have survived drought couldn't survive drought, plus deflation, plus bank failures, plus collapsing commodity prices. But the crash taught America lessons that shaped financial regulation for 80 years. Roosevelt's New Deal rewrote the rules of finance. The Securities and Exchange Commission was created in 1934 to police the stock market. Before the SEC, companies could publish false statements and insiders could manipulate prices. The SEC required disclosure, transparency, and honest accounting. The Federal Deposit Insurance Corporation guaranteed bank deposits up to $2,500, currently $250,000 per account. This single innovation restored confidence in banking and ended bank runs. The New Deal imposed strict margin requirements. Today you need at least 50% down to buy stocks on margin, not the 10% of the 1920s. Glass-Steagall separated commercial banks from investment banks, so people's savings couldn't be gambled on Wall Street speculation. For decades, these rules worked. America never again experienced anything like 1929. Bank failures became rare. Between 1945 and 1980, fewer banks failed than in a single year during the early 1930s. But memory fades and greed never dies. By the 1980s, politicians and bankers argued that New Deal regulations were outdated and stifling growth. Glass-Steagall was gradually weakened and finally repealed in 1999. Margin requirements were relaxed. Complex derivatives markets exploded without oversight. The reasoning was always the same. Modern markets were more sophisticated. Computer technology made everything safer. Regulation held back prosperity. Every generation believes it has transcended basic economic laws through superior intelligence and better tools. The 2008 financial crisis proved them wrong. Banks created complex investments backed by mortgages given to people who couldn't afford them. Rating agencies rubber-stamped dangerous securities as safe. Americans were told housing prices could never fall nationwide, echoing the permanently high plateau rhetoric of 1929. When the bubble burst, millions lost homes, jobs, and retirement savings. Only massive government intervention prevented another Great Depression. The pattern repeats because human nature doesn't change. Every generation thinks it's smarter than the last, that technology has solved old problems, that this time is different. But the fundamentals never change. When people borrow money, they can't repay to buy assets at unsustainable prices. The result is always the same. What makes this dangerous today is the global scale. In 1929, the crash mostly affected Americans who owned stocks, perhaps 10% of families. Today, financial markets are interconnected worldwide. Pension funds, insurance companies, and sovereign wealth funds chase the same investments. Modern derivatives can amplify losses globally in milliseconds. We're closer to 1929 than most realize. Interest rates have been near zero for over a decade. Asset prices have soared beyond historical norms. Margin debt has reached record levels. New financial instruments promise easy profits with minimal risk. The difference is that now it's the entire world drunk on easy money. So what should you take away from 1929? First, bubbles are obvious in hindsight, but seductive in the moment. When everyone around you is getting rich from some sure thing, that's when bad investments drive out good judgment. The time to be most careful is when being careful seems most foolish. Second, never invest money you can't afford to lose, and never borrow money to invest unless you can survive total loss. If you wouldn't be comfortable losing 100% of an investment, don't make it. Third, financial innovation is often old gambling in new clothes. Whether it's 1920s margin trading, 2000s mortgage derivatives, or today's cryptocurrency leverage, the names change, but the mathematics of risk and return remain constant. Markets can stay irrational longer than individuals can stay solvent, but they cannot stay irrational forever. When reality breaks through fantasy, it does so with devastating speed. The next crash is always coming. The only questions are when, how big, and who will be ready. Those who understand history have the best chance of not repeating it. Those who ignore it will be swept away when the tide turns, just like millions who thought they were getting rich in 1929 and discovered too late they were getting poor. If this gave you a new perspective on market cycles and financial risk, hit subscribe. History has the patterns, and I'll show you how to read them before they repeat.